In this presentation, we will record the home loan, the mortgage into our personal QuickBooks file and make adjustments to payments to reflect the interest and principal portion in accordance with our amortization table. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are on the home page. We currently have the open windows open. You can open the open windows by going to the view drop down, selecting the open windows list. We're now going to open the balance sheet by going to reports, company and financial, and going down to the balance sheet standard, changing the dates up top, customizing the report, dates to 01/01/20 to 12/31/20, January through December, and the year we are in, 2020. Now we'll change the fonts and numbers while we're here. Change the font to 11, then OK. Yes, and OK. So here is our balance sheet. We're going to enter the loan balance on the balance sheet at the point in time that we started entering the data into the system. Then we'll adjust the income statement or profit and loss for the two payments made, breaking out those two payments between interest and principal portion. To do that, let's see the income statement to see our end objective here. Profit and reports, company and financial, profit and loss. Changing the dates from 01/01/20 to 12/31/20, January through December 2020. Let's customize the report. Change those font sizes to 11. Okay. Yes. Okay. And then if we scroll down, we're concentrated on these payments here, the mortgage payments. Those are the full payment. We want to break them out between interest and principal using the amortization table, this one we made last time. So I'm going to go down the amortization table, and what we're saying is if we look at the last loan statement and or look at our amortization table, we'll be able what the balance is. So in other words, if we look at the statement as of the time that we entered into the system, which would be January or December of the prior year, the loan statement would say you still owe $326. That means, according to our amortization table, that we are on payment 112. And I'm going to scroll back all the way up, and I'm going to scroll down a little bit and use the freeze panes so we can see these headers. So I'm scrolling down so I can just see this amount, putting my cursor in A11, and then I'm going to go to View, and then freeze the panes. So now we can see the headers as we go down. So I'll go down so we can see them. So we're going to say that this is the balance. So if that's the balance, then according to our amortization table, we must be on payment 312 of 360, 30 years monthly payments. So this is what we're going to start with. Then we made two payments of $2,300, which we charged all to expense, which we now need to break out between interest and principal, which are different for the two payments. So we'll start off by putting the original loan balance as of the time that we started tracking the data, not the original loan balance of the entire loan this time, just the loan balance as of the date we started entering the data at the beginning of the year, which is this $126,471, or that would be $326,471. So we'll go to QuickBooks to do this, and we'll go to the lists, chart of accounts. We want to add a new account just as we did before. We'll go to the accounts drop up, new account, and it's going to be a loan type of account. Continue. And I'm just going to call it loan on the home. And obviously, if we had the loan company, we might want that. If we have a number for the loan, we might want that. If we have multiple loans, then it would be nice to break them out using those types of resources. But we're just going to have a generic name, loan on the home. And we'll say save and close. Going to double click on that item now. And as of the 12/31/19, the day before the year we're working on, we're going to increase that amount by the 326,471. So that's this 326,471, and again, we wouldn't get that from the amortization table necessarily. We would get it from the loan balance, and note that that would typically mean, according to our amortization table, we are on payment 300 or 112. So then the other side of it, where's the other side going to go? it's going to go to equity. We're going to record it to equity. So we'll go up to equity and put it to owner's equity and record that. And okay. And then if we go to our balance sheet, we'll see now the loan is on the books. That's good. And it recorded the other side to equity. So it recorded it here, reducing equity just like before. So now the home, if I double click on it and go to the prior year where we entered the data, we've got the home increased it substantially, and then it went down, of course, by the loan. So the net value is the home minus the loan. So we'll close this back out. And now we want to record the payments properly. So if we go to the profit and loss, whenever we see a payment each month, we're now going to have to use the amortization table to break it out. So let's do that. We're going to go change these two payments by double clicking on it. And then I could double click on either one of these. I'm going to double click on the first one, the January payment. And I'm going to assume these were made at the end of the month. They were made in the middle of the month. And we're just going to be okay with it being in the middle of the month or the end of the month, whatever it's going to be on payment number 112. And we need to make now payment 113 is the one we are on now. And we still paid $2,300, but interest was for 1632 and principal was 668. So we need to break those two out. So we'll go back to our table. Now this amount is right. That's what came out of the checking account. And if we saw it in the check register, it would look the same. We would still have this, and we would use the splits to split between the two to have two accounts down here. So we have mortgage expense. It's still necessary, but the mortgage expense is only should be, actually, we shouldn't call it mortgage expense. We're going to call it mortgage interest, or how about just interest expense? Interest expense. Now we could label it interest expense on the mortgage. We might want to label out different categories of interest expense, or group all interest expense into interest expense. And so we'll set that account up. It's going to be interest. We're going to say continue, and that's what we want. That's going to be for only the interest portion here. So if we go back to our table, the interest portion is going to be this 1632. So if we go back over, the interest portion is only the 1632. I typically put in the loan number, like the number of the payment. So this is payment 113. And then on the other side, we're going to have the reduction of the principal. So that's the loan on the home. So that's the liability. And that should be the 668, which is the other side. QuickBooks has given it to us, 668. And that's also payment 113. So then so now we have to break this out every time between these two payments, and those two amounts, the interest and the loan, the payment will remain the same. Interest and the loan will differ every time, and we'll need the amortization table to do it correctly. So we'll say save and close. Yes. Okay. It removes it from this transaction report. If we close this back out, then we see it in the interest now. If we go to interest expense, there's the interest expense matching what we have here. And then the other side's in the loan. So if we go back to the balance sheet, then the loan is now at the 325,803. If we double click on it, there's what we put it on for. Here's the decrease. It's now at 325,803. If we go to the amortization table, we have the 325,804. It's off by rounding because there's pennies here that were rounded. So now we'll do the second payment, same thing. We already made the payment, but let's break it out between interest and principal. So we'll close this back out. We're going to go back to the profit and loss, and we're going to go to the mortgage expense and double click on it. We'll double click on that payment. We're gonna say that we want the interest expense. So this amount's the same, but the interest portion now is the 1629, a little bit different than the last one. So now it's 1629. This is payment 114. The difference QuickBooks gives to us, because that's what we need to be in balance, and that's going to go to the loan on the home. which is 171 or 671. We can use that as a check because QuickBooks should calculate it for us and it should match. And that's 114, and that's what we have on the second one. So notice it's similar, slightly different, and each one will be, and that's the issue. Save and close. So we can't just memorize the transaction. That's the kind of the problem with these types. So we'll say okay, close this back out. So now the mortgage expense is gone because we don't really have a mortgage expense. We have the interest expense and then the reduction of the loan balance. That's what it should be on an accrual basis. And so then the interest expense, if we double click on it, shows these two amounts. They're not the same, but they're in accordance with the amortization table. And if we close this back out and go to the balance sheet and double click on it, we'll see here's our loan balance going down properly in accordance with the amortization table to 325,132. And that's the 325,133. It's off by that dollar again. So that's just rounding. So this would be the right way to do it, but again, it takes more effort to get. We have to get the amortization table, which we might get from the loan company. They might provide us, but oftentimes not, or our accountant. And then we would have to basically make that payment that would adjust it each time. And so it's a little bit more time consuming also, but it does keep the loan balance correct. So it's good on the balance sheet side. On the profit and loss side, we have to notice that the net income is not on a cash basis now because we're paying way more in cash than we're recording in interest. So it's recording this on more of an accrual statement, an accrual basis, and we have to recognize that and make any adjustments on a cash basis that we would need to do budgeting if we're doing a cash-based type budget. For more accounting information and accounting courses, visit our website at accountinginstruction.info.